Ken Goldberg with DSEtrading.com. Today we're going to look at one of the more difficult components of the DSE algorithm. Actually, we're going to look at two, but they work so well together, sometimes they're mistaken for the same thing. Today's topic are Elliott waves and Fibonacci retracements. So I'm not going to go into a very detailed explanation of Elliott waves. There are tons of websites and pages and books and all kinds of graphics you can go to find out about that. But if you know about that, or if you're interested in how we use it in a general way. In other words, we look at a long-term trend and we try and break it down into what Elliott referred to as an impulse or a corrective wave. Elliott, or Ralph Elliott, was an accountant back in the 1920s and 30s, became ill, and while he was bedridden, studied the market and came up with this series of repeating patterns which tracked the crowd's behavior, how they dealt in the market according to their mood. And so these Elliott waves track herd and crowd mood, and they unfold in a regular pattern. And this pattern, starting from the upper left-hand corner of this chart, which just so happens to be crude oil, but it works in every chart. The pattern is 1, 2, 3, 4, 5. And because this pattern is moving from the upper left-hand corner of the chart to the lower right-hand corner of the chart, this is a downtrend. In a downtrend, these 5 waves are going to move with waves 1, 3, and 5 in the direction of the major trend. The trend is down, waves 1, 3, and 5 are moving lower. The counter trend waves or moves are waves 2 and 4. Those waves 2 and 4, are typically equal or approximately equal in size, but different in their complexity. So notice wave 2 here goes up, down, and then up, whereas wave 4 just goes almost straight up. The height of the wave, the point movement, is relatively equal. The path of wave 2 and wave 4 are different. And that rule of Elliott is called the rule of alternation. Wave 2 and 4 alternate in complexity. Again, more detail than is needed, but I'm going to explain it quickly as I go along. Wave 3 is known as the recognition wave. This is when the crowd recognizes that the former uptrend, which went sideways in what became wave 2, that former uptrend is over, and the crowd recognizes that a new trend is taking place. What's that new trend? It's a downtrend. Why do we know it's a downtrend? Because we have 1, 2, 3, 4, 5 waves in the opposite direction. What happens after 5 waves? Why aren't there waves 6 and 7 and 8? And that's not the way the pattern historically unfolds. And Elliott in the 1920s and 30s studied wave pattern going back to the early 1700s. So at the time he created the Elliott wave theory, he had 200 years of stock price data, and he found this pattern recurs most often. 5 waves in this downward direction is a downtrend. This is just as obvious in an uptrend. The 5 waves would start at the lower left-hand corner of the chart and move up and down to the upper right-hand corner of the chart, and that would tell us that the previous downtrend was over and that the new uptrend was in force. So here we have a downtrend. It's clearly labeled with 5 waves. There are no rule breaks, and the details of the rule breaks or violations of Elliott wave rules you can find on your own, but trust me when I say there are no rule breaks here. Therefore, we have a valid 5-wave decline. What happens when an Elliott 5-wave decline ends? a three-wave bounce follows. Where does that three-wave bounce go? Well, according to Elliott, it often goes halfway back to its origin. So since this began when crude was at around 112, and it ended just last week when crude spiked down to 39, let's round this up to 40, and let's round this down to 110. That's 70 points of travel. Half of that will be 35 points. We'll add that to the rounded up 40 level, and that brings us to 75. So under Elliott, there's an expectation in the next, say, 9 to 15 months from now, which is August 2015, there's an expectation that we're going to have a rally that looks like up, down, and up. Even though I've drawn these blue arrows without interruption, the path will actually look more like this: up, down, and up, which is a three-wave corrective bounce. That bounce should find resistance approximately 75, give or take, and that will satisfy the Elliott wave expectation for what is coming in the next 9 to 15 months. So from this current 40 level in crude, a rally up into the 75 area, give or take 5 points, so at least 30, maybe 40 points of rally. That's almost a doubling in crude, and if it gets up to 80, that will be a doubling in crude. So what are these lines here? These are called Fibonacci retracement lines. The first Fibonacci retracement line, or resistance level, comes at the 38% rally point from the prior decline. So we know the decline was from 112 to 39, and that first 38% Fibonacci retracement comes in at $67.22. You can see here it says 0.382, that's 38.2%, and the price of 67.25. The next level up says 0.500, it's a little bit covered up because of these arrows, but let me move them. It says 0.5, which is $75.82.5. The next most common Fibonacci retracement level is 0.618, or 61.8% retracement. That's $84.42.5. That's right here. And the final Fibonacci retracement line is at the 78.6 or 0.786 retracement level, and that would be up at the $96.65. So these first three, the 38, the 50, and the 62, which I round up, so 38%, 50%, and 62% retracement levels, these are the three most common bounce targets. So a common way to state this would be we would now expect a three-wave rally somewhere into the 75 plus or minus 7 zone. 75 plus or minus 7 or 8 points. That zone encompasses the Fibonacci 38%, 50%, and 62% levels. Now, it's very rare that a correction will exceed 78.6% bounce and roll back down. In other words, this bounce could actually get up to the 78.6% level of 96.65, but if it gets much above there, then there's something possibly wrong with the wave count and the expectation. So any move that takes prices above here would cause serious doubt to whether or not this 5-wave decline was an actual 5-wave decline. But we don't make those determinations in advance because this is a year or two away, and we'll have a lot of help from other DSE components when prices get up there to tell us what the odds are that prices will stay below 78.6% or not. In fact, we'll have those same DSE components telling us what the odds are of prices getting above the 38% Fibonacci retracement or the 50%. So at each of these Fibonacci retracement levels, we will use all of the other DSE components to help us probability rank whether or not prices are going to continue higher or roll over and head lower. So in general, we use Elliott waves to help us identify when a trend at larger degree is ended, which we can see that if it hasn't ended as of last week, then we allow this red arrow. We allow a little bounce for a couple days and the red arrow to take it to one more new low. And there's some advanced Elliott wave charting methods that tell us that we cannot rule this bounce and new low out yet, but the market certainly does not have to bounce and decline because the low of wave 3 was taken out in this wave 5, and because wave 5 is approximately equal to wave 1, then the minimum expectation for a completed pattern from the peak at 112 to the low at 39 and change has been made. DSE would come up here and warn us that selling actions are not indicated and buying actions are. And that's what we want the DSE to tell us. In other words, the news right now is very bearish. Crude's going to go lower. There's crude all over the world. Nobody cares to be a buyer because everyone knows crude's going lower. If you just follow the news, you're going to be motivated to be selling crude here. Short it, sell it, whatever the selling action is. However, that is not the optimal action. The optimal action is to notice that five-way decline has orthodox structure. There are no rule violations. Wave 2 and 4 alternate in complexity. Wave 5 and 1 are approximately equal. And wave 3, which is the recognition wave, is the longest wave. That's a perfect definition of an Elliott wave impulsive pattern that is mature. The expectation, again, to summarize, following a mature Elliott wave impulsive pattern is a three-wave bounce in the opposite direction. Up, down, up in the opposite direction. Where? About halfway back to the origin. That's approximately 75. Those are all Elliott wave assumptions. Under Fibonacci, we can define that bounce into a tighter cluster of 38, 50, and 62% retracements of that decline. And so we put the Fibonacci retracement lines on the page. And there you have it. That is, in a nutshell, how we use Elliott wave and Fibonacci at every degree of trend, at every buying and selling decision we are anticipating. It's not the only thing we use. It's not even one of the major things we use, but it is one of the things that the DSE's algorithm is programmed to seek and find and alert when conditions are such that the prior trend has a high probability of maturity and the new trend has a high probability of beginning. Thank you for joining us. This is Ken Goldberg with DSEtrading.com, and join us in the live market chat room where we use all these tools to make objective buy and sell decisions. Thank you.